Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back, everybody. Like the man said, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you hear anything on this show that you'd like more information on, feel free to reach out to me. You can go to my website at bullingtoncapital.com, or you can call me, 330-664-0700, or you can email me. By the way, there's a contact us form on the website. So if you don't have a pen and paper, don't worry about it. Just go to the Contact Us page, and you can send in a little note there. Or it's bill at bullingtoncapital.com. Wow, that's a mouthful. Anyway, just looking around, and boy, the stock market looks a little rough. It's been rough for quite a while now. Actually, interesting. The market peaked in, looks like it was January of 22, and here we are near the end of 24, and it's down about 14% from its peak. So not unusual, incidentally. That's not, I think that's still, after all these years being in this business, that is the hardest thing for the individual investor to deal with, is that the market's never going to behave like they want it to. And it's just not. And I think a big part of the reason is because 20 years ago when I was doing this, I was only 40. now I just turned 60, and it's a whole new. Every day somebody else is 10,000 people are turning 60. So I never really thought much about that when I was younger, thinking that, oh yeah, I forgot that people are going to keep aging, so it's the people that are entering those age brackets that have to start thinking about certain things once they reach those brackets. And so it's not news to me, but it will be news to them. And I didn't really give that a whole lot of thought, not up until the last few years. And now it's like, oh, okay, yeah, I get it. I just assumed that people would study this stuff, and at some point in time, I would be relatively useless. But I can tell you, the other thing that I didn't count on was the innovation that was going to appear in the financial services industry. It's unbelievable how many funds there are now, and there are more funds than there are stocks to invest in, and that is just wild. And by the way, the market cap weighted funds like the S&P 500 are typically in the top 10% of every category. So you hear a lot about people who will just buy the index, and the S&P is not really all the indexes. There are other indexes there, and I will tell you this: that the growth indexes have had a tendency over the past 10 years to do better than the more broadly diversified fund, and there's a reason for that. And I'm going to try. I can't cover that on the radio, though. That's too complicated. But I'll have to try to set up a seminar for that over the next 6 to 8 weeks or so, and see if I can get the old gang back together again. I used to do a seminar once a month, and then I went to once a quarterly, and then the pandemic hit, and that stopped doing any of them. But so we will. We're planning on another one, and it'll be sometime before the first of the year, and it should be a lot of fun. And there's been so many developments. It is mind-boggling how fast change happens today, and it's one of the reasons that I don't utilize a ton of price movement strategies for individual stocks. I use it for exchange traded funds, and I'm trying to select those funds I think have the best chance of performing the best over the next few years. Um, Fixed income has become really attractive now. For the longest time, I remember talking about how interest rates were going to go down 2007, 2008, and everybody was upset with me. I was just looking at the economic data and looking at history and trying to see if there were any similarities. And there weren't that many, quite frankly, that were that similar. And actually, there's no time in history that's similar to what we have now. Um, I mean, really similar, not just one or two items, but there were more items when interest rates were going to be going down. I thought that was a good thing to do at the time, was to buy long-term fixed income, because when interest rates go down, it goes up. But you can't stay there forever, because now that the interest rates moved against that, they went down a lot. Bond prices went up, and then they reversed, and interest rates started going up, and then bonds have been horrible. I mean, I expected it to be bad. I really didn't expect it to be as bad as they've been. That mind-boggling. I look at the aggregate bond index. It peaked in 2020. What year is it again? It's almost 2024. So it peaked in 2020, and it's down off of its high price there. That the price of the bond, aggregate bond index fund, is down about 24%. That's mind-boggling. And the AGG, that's the one from BlackRock. The other one from Vanguard. The one from BlackRock's down 22.5% from its peak. Just it's mind-boggling that has been so difficult. By the way, when at some point in time, I don't know when it's going to be, and they may end up having to continue to increase interest rates, which means those bond prices probably going to keep dropping over the next year or so. And it makes it really tough if you're not holding on to super short-term bond funds. If the average maturity of the bond in your portfolio, and by the way, most people need somewhere between 40 and 50% into fixed income just to keep their sanity, because if you were 100% in stocks, you'd be whipsawed all over the place. Now, you can do that if you have enough money and don't need to take out more than 2 to 3% of your assets a year. That's fine. But if you're withdrawing anything more than 3 or 4%, you can't afford to be 100% in stock, because you could end up getting a big dip that takes 10 years to recover, like how the market peaked in the year 2000 and then didn't get above that level and stay above it again until 2010 or 11. And that's if you reinvested your dividend. So if you were taking any money out of that, holy cow! I mean, there are a lot of older people that are working now because they didn't know what I just talked about, and it's a sequence of events risk. It's what they call it. It's a timing risk. You get to retirement, you want to start taking out money, and hey, the stock market's averaged 9 or 10% a year if you look back far enough. But it's also had multiple 10-year periods where the returns were negative. And so it's had 10-year periods where the returns were awesome. And the average has been pretty high, but it's so volatile that if you're taking money out and it drops like that, you're going to have to cut way back on your lifestyle, and that's what everybody wants to do in retirement, right? But anyway, so my point here is that you have to be careful. You've just got to be careful. There was an old rule that said take your age, subtract it from 100, and then you could put that in the stock market. That's okay. That would have a 50-year-old, 50 from 150, you'd be roughly 50-50. That's not that bad. But 60 minus 100 is 40, so you'd only have 40% of your money in stocks. That's still pretty good. I mean, that's actually not a bad. I think it's working better now than it has in the last 4 or 5 years. But if you knew nothing else, take a look at your portfolio. If you're more than 60% invested and you're above the age of 60, maybe you should take another look at that. That's all I'm saying. And on that fixed side, on the fixed income side, you do not want to buy the highest yielding stuff. I'm telling you, I got an email from a longtime client. He's a good guy, super smart. And those stories that you read, I am so glad he wrote to me because he's looking at this fixed income fund. They were saying they were paying out some crazy amount, 9 or 10%. And I'm like, all right, see, I know how they do that. And the risk, and by the way, this was in a major financial publication. By the way, the major financial publications are all struggling. They're all struggling because nobody's buying magazines, or there are some idiots out there like me who still buy them. But I am the minority. Most people are not buying magazines anymore, and they're not getting a lot of ad revenue for that. So they're online, and the magazines are all there. Every article you see published in their magazine is typically either online right after it publishes in print or about the same time. So anyway, I'm looking at this article, and it's from a very famous financial publication. How good it is, that's debatable. But anyway, it's famous. And the article is written, and the people are very good writers. And they were talking about this bond fund as if, hey, look at this. Yeah, and I'm like, I've seen this so many times. It's just not funny. And what they do is they'll go out and buy junk bonds, or they'll take on debt that's not even rated sometimes. And if you read through the whole prospectus, which incidentally nobody does except for idiots like me, you read through the whole prospectus, you find out that some of the bonds are not even rated, and they're basically short-term loans directly from the fund or another institution, and that the fund purchased it from. So it's a direct obligation of these companies, and if they go belly up, by the way, you get to stand in line as one of the creditors. Okay, and that's my point here, is that the risk in these things is astronomical. If you see something that's got more than a 5% guarantee rate, okay, if it's a couple of percentage points more than 5%, I should say, so somewhere around the 7% range, there's risk. There's a lot of risk there, and I don't care what these prospectus has in it and what they've written in it. There's risk there. There's no way to get that type of income without taking a fairly substantial amount of risk. Okay? Unless you decide to take a fixed annuity, which is an insurance product. It's not a bond. Okay? It's actually an insurance product. What you're doing is you're insuring your income. They have fees for that. The internal expenses on fixed annuities are relatively high. Why? Because they pay a lot of money. That's why. And when you're paying out a lot, you have to charge more. And it's just the way that it goes. But that's why it's so important that you get the guarantees down, because that's the whole idea behind insurance products to begin with. You pay a premium for a guarantee. That's what you're doing. In this case, you're guaranteeing income. Okay. If you see how the investments grow, the growth rate on these investments is not going to keep up. It's my opinion that it won't keep up with the guaranteed amount. The guaranteed increases that they're making are probably going to be larger than the increases in the portfolio values. That's fine. That's why you buy it, for the guarantee. You hear me what I'm saying? The underlying investments are probably going to be beaten by that. The guaranteed amount's probably going to go up faster than the investment does, which is fine if you're looking for the income, and that's what we buy them for. That's why I bought mine. I don't care I could care less what happens with that money. If it surprises me and does better than the guaranteed, I'm happy because I was happy with the guarantee. I'll give an example. Somebody's going to be 67 next year. You got to wait for 1 year to turn on the guaranteed income with this particular product. So they put in what did I start off with? I don't know why I started off with that. Hang on a second. I'm going to rerun this thing. And I'm going to start off at age 66. You got to wait for 12 months before you turn on the income. We put in $100,000. By the way, it doesn't matter whether you're male or female. So next year, I'm going to be able to get $7,750, and that's going to be a guaranteed income for the rest of my life. Now, if you want to play around on this website that I just pulled those numbers up from, just email me or call, and there's a website there you can go and put your own numbers in there. I just put these numbers in because I like to play around with it. And I'm looking at the clock now. I've got about, probably 60 seconds left or so before I have to take a commercial break. But this is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can find me on my website at bullingtoncapital.com if you want more information about this, or you'd just like to set up a quick phone meeting to talk about it. That's fine. A lot of people have just emailed this link and let them get on there and play around with it themselves. That's fine too. And at any rate, we're going to be talking a little bit more about this when I come back from the commercial breaks. We'll talk a little bit about stocks, which sectors are looking strong right now, despite the fact that the market's been going down fairly significantly, and where I think I might see some light at the end of the tunnel. And I think I really should be having to take a commercial break here, but I don't hear the music.
So you catch me when I fall.
Because of the huge demand, Crab Fest has been extended at the Lobster Pot in beautiful Willoughby Hills. And here's what you got. 1 1/4 pound jumbo Alaskan snow crab legs, which come with 2 side dishes for, get this, only $25. And hey, if you still feel hungry after that, order another pound for only $19 more. And as far as their other items on the menu, it's endless, with pretty much every type of the freshest seafood in the city. And if you're not a fish eater, they have several meat items on the menu too. And don't forget about the Lobster Pot's beautiful enclosed outdoor patio for all of those beautiful summer and fall evenings. That's Crab Fest at the Lobster Pot. Open Wednesday through Sunday for dinner. Call now for reservations at 440-569-1634. That's 440-569-1634. Or go to their website, thelobsterpot.com.
From an idea that started in 1967, Our Lady of the Wayside has grown to serve almost 900 children and adults with developmental disabilities throughout Northeast Ohio. It's an operation that is still growing thanks to tremendous support and generous donations like the Wayside's Car Donation Program. You can donate your ride to the Wayside for a great tax write-off by calling 1-800-368-6262. The Wayside is also looking for people to join their team. They hire for attitude and train for skills. Visit thewayside.org to apply today.
Do you ever find yourself saying, I need a vacation? Vacation Fixation can help. At Vacation Fixation, we specialize in all-inclusive trips and cruises to Mexico, the Caribbean, and Disney vacations. Why choose us? Our clients book through Vacation Fixation because they are frustrated with online trip brokers and timeshare scams. Whether it's a weekend getaway, a family trip, spring break, or honeymoon, Vacation Fixation will personalize a trip just for you. Want to know the hottest destinations in Cancun, Punta Cana, Jamaica, or Puerto Vallarta? Interested in room upgrades, beach reviews, or details about resort restaurants? How about finding a trip with a direct flight? At Vacation Fixation, we take all of your specific travel requests and shop our suppliers to find the best deal. What's the cost? Our suppliers pay us so you don't have to. Call 330-573-8147 for more details. Or you can visit our website at vacationfixation.com or check out the deal of the day on Facebook. Vacation Fixation.
Is it finally time to update your bathroom? Bath Planet, a division of Joyce Factory Direct, specializes in replacing and converting old showers and tubs into new, beautiful bathrooms in as little as one day. We have transformed thousands of bathrooms just like yours into a spa-like oasis that has homeowners excited to use their new bathtub or shower. Right now, all bath installations are 50% off. So call to schedule a free consultation with on-the-spot pricing. 440-243-5700 or visit JoyceFactoryDirect.com.
And I'm back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. And you can reach me by going to my website if you'd like. My website's bullingtoncapital.com. If you have any questions, you can email me, bill@bullingtoncapital.com. And there's also a contact us form. You could type the question out on the website. In fact, if you do have a question, that would be great. If you could go there and type it out. It's hilarious. I get people contacting the office quite often, but they never write down what their question is. And as you know, it's very difficult to get a hold of people today because they got all kinds of, it's just more difficult than it was back in the days when we had landline, and which is mind-boggling because it should be easier to get a hold of them. Talk about history not coming around like you think it would. That is I see that happening so many times, especially in the stock market. There are companies that you think are going to be gold, are just they turn out to be, used radiated lead, and then other companies that you didn't really expect to do that well end up doing fantastically. That's one of the reasons I really like the ETFs. I was thinking about this the other day. When I first started Bullington Capital, it was back in 2004. There were only a handful of exchange-traded funds. And I built my own models, and I was running them off of this platform on this company that would allow you to put in the stocks that you wanted for your specific models and build your own models, and then you could run it that way. You can still do that. But what happened was, the exchange-traded fund industry, it had finally dawned on them that they could do the same thing, and basically anything you can dream of has been invented. And it's out there, good, bad, or indifferent. I mean, I see some funds that they don't make any sense whatsoever, but the fund companies saw a demand for that product, not that it was a good investment. They saw that there was a demand for that product, and so they would make these products so that the investors could buy them. And I'll give you an example. Those gold funds, I want to touch them with a 10-foot pole. I would buy gold. Why would you not just buy the coin? Because if you saw the internal expenses inside those gold funds, you're not going to make any money on that, or it's going to be very difficult to make any money at all. And anyway, somebody goes, but look at the gold trust that came out. It's up 322% since it first came out. It came out in 2004. That's a long time. And the gold itself has gone up a lot more than the fund price has. So it's cost you a fairly significant amount of money to do that sort of thing because somebody has to store that gold someplace. We got to pay for that. There's insurance that they have to pay on that as well. So I think it's just it's kind of funny, but not everything is as it seems. Although the information, if you have enough time and you have enough energy, you can find out everything there is to know about any of these funds. It just takes an enormous amount of time and a lot of energy. And if you're not adept at reading financial statements, well, 2-3 years from now, you probably will be. And but anyway, so I just lost my whole train of thought there. Oh yeah, I was talking a little bit about lifetime income, setting up lifetime income. It's very important as you start to get closer to retirement age. And by the way, you know when you should start planning on retirement? When you're 12. Every time I say that, people go, "Oh, come on!" And I know. And the average person doesn't start planning until they're in their 40s, if even start then. So, and what they don't understand is it takes an enormous amount of money to be able to replace your income. Now, the average household income is a little over $70,000 in this country. That's the average household income, and sometimes it's one worker, sometimes it's two. And but that's the average. And think about that for a second. In fact, I'm going to have to pull up and I can't find it, of course. I was going to pull up my calculator. So let's say somebody, average household, let's say you just want $50,000 in retirement. Your $50,000 plus whatever you've got in pensions and Social Security. You need $50,000 a year in income from your investment to get to the place that you'd like to be. So if you have $1 million and you stick to the 4% rule, that's taking out 4% because you're going to increase it over time because of inflation. And if you took out a lot more than 4%, especially if you're under the age of 65, there's a pretty good chance that you could run out of money. And you don't want to do that. So we're going to stick with the 4% rule. We're going to take out 4% and then earmark that to go higher. So, in fact, to keep my math simple, let's say you could get by on $40,000 from your investments because you've got Social Security and a small pension, and which is pretty common around Northeast Ohio to have that type of income. So, to generate that $40,000, you need $1 million. 40,000 is 4% of $1 million. And you're going to have to invest that $1 million. Well, today you could actually do it. You can get money market accounts. I think our highest money market account, it's over 5% now. But the thing is, that's not going to. That may not go up enough to keep up with inflation, and that's pretty big. If you took 100,000 of it, put it into one of the nationwide products that I like, you have to put a lot less money in to be able to generate that 40,000. Let me see. I probably should have. I'll come back to that on the after the next commercial break. But one of the advantages of having a product that's going to pay higher than that, and I think at that age, if I'm not mistaken, I know it's over 6.5% is what the payout would be. So what does that mean? Well, let's say at 6.5% on a million. Well, that's 65,000. That's $15,000 or $25,000 if you need $40,000. $25,000 more than you need. Okay, but it's going to stay that way. So you may want to put some of that money aside, just build up, shore up your emergency fund, or even start another investment fund because, for emergencies and inflation. But this gives you pretty good options because the higher the income is, the lower the amount of money that you have to meet those income goals. And, it just makes kind of common sense right now. And I was just looking at I'm getting distracted here by all this stuff popping up on my computer screen. They must know I'm on the air. I don't know. But there's there's a story in Bloomberg about everybody needs mutual funds now, but nobody wants them, and they're giving some advice out as to what they might be able to do. And in the realm of all possibilities, incidentally, I've been thinking about that a lot this past week. There are so many options available and so many personality types. I really don't think that out of we service about it's about 150 households. Okay, so the um, no two of those households are the same. That is the mind-boggling to me, anyway. Out of the households, the people that we were working with, no two of them are the same. In fact, I don't have the only there's a small collection of investors where one party, either the husband or the wife, takes care of the investing, and the other one doesn't know, doesn't want to know. They leave that that's not my job, and I think that's kind of funny. Those are the only households where the husband's accounts look like the wife's account, because whoever is controlling that is controlling it for both of them. And that's not as common as it used to be. It used to be really common. It was either the wife or the husband. By the way, the women had a much better track record than most of the men did. I mean, it was eerie. And so I was always glad when I would sit down and talk to a new client and the female was in charge, because I knew they were probably going to make more money. But males get all upset by that, by the way, every time I say that. And I'm like, well, you know what? I can't. Here's the thing, especially in the generation that was just like one before mine, the generation just up ahead of mine. Those guys were, I don't know, a lot like Fred Flintstone. They had hard heads, and you had to have a hard head to survive in the era that they survived in. It was not the same thing it is today. Today, you've got to be really smart, got to have a good education, you got to work your butt off. Yeah, but back in those days, you could do it with just guts. Just show up, go to work, get the check, and save. And I'm not sure which is better. I have no idea. But anyway, that's the way it used to be. And today, people are much more thoughtful. The income equality is much closer now between male and female. And a lot of females make more than males do. Yeah, so it's just different. And the access to information, different. The amount of material, like the stuff that I started off with, where this guy was definitely making, he's twisting the words around to misrepresent stuff. That happens much more frequently. And I just can't imagine having to go through, because when I started, the Wall Street Journal was it. I mean, you had a local paper that had a small finance section in it, but everybody read the Journal or Investors Business Daily. And so it wasn't like you really had to know as much. There were only, I think, 1,500 mutual funds around. There were 10,000 stocks on the New York Stock Exchange, by the way. But today, those numbers have flipped. There's only about a little over 3,000 stocks that are big enough to be included in one of the indexes or be listed on an exchange. Okay? A little over 3,000. There were well over 10,000 back in those days. And there were only about 1,500 mutual funds, and exchange-traded funds hadn't even been invented yet. So what's my point? Well, we had to learn a lot about a whole lot of different things back in those days. And today, it's all out there, but it's very tempting not to read it and just invest in it based on its track record. That's a bad idea. That's a horrible idea. But that's how most people that are doing their own investing, that's how they're doing it. They're looking out at the track record as if that's written in stone for the future. Bad idea. I mean, really bad idea. And then when they get stung, a lot of them call me, and unfortunately, it's not going to be as easy to get the money back as it is to lose it. And that's that scares me a lot. They're not teaching this stuff they should be teaching it in high school. It's not super. If they're teaching programming in high school, they can definitely teach this kind of stuff. Let me put it that way. Is it difficult? Is there a lot? Yeah, kind of. There is. But what are your choices? I mean, in America, you got to learn how to drive a car, too. Maybe if you live in New York City, you don't have to, but you better be making a lot of money to live in New York City. But it's just one of those things that I feel like the educational system's just, they're overlooking it completely. And they need to start incorporating some of this into their curriculums. And I know teachers, they feel like, yeah, right, we got enough to do. And you're right, I get it. Teachers today, it's mind-boggling the kind of stuff that they have to do. But that doesn't mean that you should shun this completely. And I just don't see a whole lot of classes being taught that are extremely helpful or even very helpful for kids. And their minds absorb the information much better when they're in their early to mid-teens than they do when they're in their 40s or 50s. It's just how things work. So anyway, I'll get down off my off my stump now and start to talk about some of the other things. By the way, again, going back to that income, if you can take out 4% a year plus inflation, you're doing pretty good. What really helps to being able to do that is if you had a large portion of your money that was providing guaranteed income that's higher than 4%. That's what the annuities are for. They're higher than 4%. They're extremely competitive now, and they change, by the way, just like Treasury rates change. The biggest difference, though, one of the biggest differences, that rate is going to be good for as long as you own it. Okay, so if you live to 150, first of all, congratulations. Secondly, you're still going to need money, and insurance companies on the hook to pay that for as long as you live. And I've only got a few seconds before I have to take a real quick commercial break, so I'll just point you to my website. If you hear something that you want more information on, my name is Bill Bullington. The website is bullingtoncapital.com, and there's a contact us page there. Reach out to me. I'd be glad to hear from you, and I will be back right after these messages.
This is the story of a runaway with no way home and no way out. I threw the best of me away. I had my chance, it's too late now.
3 words my dad drummed into us boys all our life. The 3 words that define why it works.
Consider it done.
We talk a lot about Wallakadoodle, which is making it feel like everything was fixed by magic. But that's really the icing on the cake. The cake itself is...
Consider it done.
Because a plumbing problem's a rather unpleasant interruption to your day.
Nobody calendars in time to deal with an unexpectedly broken water heater, or sewer line clog, or burst pipe.
So what you want, in one sense, is to have one of our straight-talking, hard-working, do-it-right plumbers fix it for you.
But really, you want the whole issue taken off your plate, so you can get back to your regularly scheduled life.
That's what Consider It Done means. As soon as you call us, you can consider it done. Problem solved, fixed, and fixed right.
So the next time a plumbing problem interrupts your day, just call us and...
Consider it done at WyattWorks.com.
Thinking about updating your home? Well, Joyce Factory Direct specializes in replacing old, outdated windows. Proudly made right here in Cleveland, Joyce Windows features their exclusive Smart Shield high-performance glass, which means you'll be getting the most energy-efficient windows for your home directly from the factory. Customers just love how much warmer their house is and how easy their new windows operate and clean. Right now, you can save 50% on all installations. Just call to schedule a free consultation with on-the-spot pricing, 440-243-5700, or visit JoyceFactoryDirect.com. You've heard the saying, all good things come to an end. Well, not always. Sometimes they just take a break. That's what's happening with Our Lady of the Wayside's car donation program after 24 years and 96,000 rides donated. Pretty amazing. Here's the story. The car lot's owners sold the property, making it impossible for car donations to be accepted at this time. According to the Wayside CEO Terry Davis, the next right steps will be determined and communicated soon, so stay tuned. In the meantime, Terry and the entire team at the Wayside thank you for your continued support of the 450 individuals with developmental disabilities in the Wayside's care. And please take note, you can still support them by making a donation at thewayside.org.
No doubt about it, we're spending more time at home, which is the perfect time to make it more functional and beautiful. Hi, Ed Flash Ferentz here for Artistic Renovations, Northeast Ohio's premier and award-winning remodeler. Artistic did a fantastic job with our kitchen in 2016, and last year, they were back for the master bath. Oh my word. Do yourself a favor and go to artisticreno.com. Believe me, you'll love their ideas and without question the finished product. For a virtual consultation, call 216-520-0838 or visit artisticreno.com.
And we're back. Actually, I just answered an email live during the show. Now, I can't always do that, by the way, but just so happens today I've got all my equipment up and running right in front of me while I'm doing the broadcast. And I'm actually broadcasting from home. So this is pretty neat. I'm a really big fan of an awful lot of technology. Some of it drives me crazy, but I guess you got to take the good with the bad. Anyway, I'm running another illustration here, and if you'd like to call into the show and ask me about your own situation, I can run this while we're doing the show. So here's the one I'm running right now. The assets dedicated to lifetime income. I just put $100,000 in there, and I'm going to do a joint. And I'm going to assume that one of the spouses is 60 and the other is 57, and that they are going to start to draw income a year from now. Okay. So, by the way, this just works off the younger spouse's age, incidentally. There's a whole bunch of reasoning behind all that. We'll come back to that later. So I've got, let's see, 100,000. One spouse is 57, the other is 60, and we're going to start taking income from it next year. And so if I wait a year from now, that $100,000. Remember, one person is 57, the other one's 60. So younger person will be 58, and they'll get $5,756 for life. Now that's for both of them. If one of them passes away, the other will. Well, there are a lot of different options on it. They could continue that income if they wanted to. They could take a lump sum. The lump sum might be higher or lower. There's no penalties on taking lump sums and stuff like that. When somebody inherits it, and that's for a joint. So, and those are pretty young people. If I go back and let's see, I'm going to change this one. $100,000. This person's single and is 69, going to be 70 next year. Puts $100,000 in. So the 69-year-old, because they're a little bit older, when they start taking at age 70, which is the longest you can defer taking your Social Security, then their income off the $100,000 is $8,256. That's pretty good. That's really good. That's a guaranteed lifetime income. So as long as they live, again, they live to 150, they're still entitled to that income, and it's pretty good. It's actually one of the better rates that I've seen across the entire country with a company who's A+ rated. That's kind of a big deal to me anyway. I want to make sure that the company is solid financially. And A+ is a really good rating to have, and those are from insurance company ratings, by the way. So if you have a question on these products, again, feel free to reach out to me. Most people, the reason I started doing these, I've gotten a bunch of questions. Hey, Bill, you used to talk about stocks all the time. Now you're talking about these fixed annuities. Yeah, well, there's a reason. And the reason is the returns that they're guaranteeing on these products are going to be incredibly difficult to match in the stock market. I still have 60% of my money in stocks. Actually, it's closer to 70, 75, but which is not like 100, which I used to be. Why was I 100? Well, I was younger, and I feel like I know what I'm doing, and I don't panic. So when the market goes down, I just stop looking at my statements. I stop looking at the account balances. Following the markets, I know approximately how much I'm up or down. And so I don't actually check the balances until the market's had a good rally. And I would, by the way, the people that I've seen that have done very well in markets, that's kind of the same thing that they've done. And I get it. It's very difficult when you see that the S&P 500 was 14, 15% higher almost 2 years ago now. And that's tough. But it's not the first time this has happened. And in the long run, you look at that graph over an extremely long time period, nothing else has kept up with it, and that's the price. The price you pay is you're going to have a lot of fluctuation. When you get too old to do that anymore, or you feel like you're too old to do it, and that's the biggest part of the equation. If you feel like you don't want to go through that route anymore, that's why these other products are so important. And there are a ton of people. The fastest growing segment of the population is 60 and over. Every day, 10,000 people turn my age. So you get to my age, and you body's aching like it's never ached before. Especially when you played Division I football for 5 years. I've got amazing injuries that I've forgotten about, and then when they started hurting again, I was like, oh yeah, I remember that. But anyway, it just starts to remind you, I'm probably not going to live forever, and I would like to have a little bit more income. And unlike old annuities, when you died, the insurance company oftentimes would keep the money, whatever the balance was. These don't work that way. These give a really nice income. And when you pass away, if there's still money left in the account, because it is invested, it's an investment account, if there's still money there, then they'll give your beneficiaries the balance. So that's pretty good. I'm looking at this going, wow, why weren't these around when I was really young in the industry? That would have been very helpful. Put it that way. So yeah, if you want more information on that, it's a really good deal, I think. That's my personal opinion. I think given all the other options that you have, if you're, I will always have a stock portfolio that's overweighted in growth stocks. Well, I shouldn't say always, but because I don't know what the market's going to be 10 years from now. Things might have changed. The reason I'm saying growth-oriented stocks today is because over the past 10 years, the algorithms are just math formulas. They're like recipes. So the recipes for most of the funds that have done very well are up in the top 10%, are using speed, like how fast the stock goes up. They call it capitalization. They didn't realize when they were doing this. You'll get a lot of people who think they know a lot about investing that will argue with you over what capitalization means. Just ignore them. The capitalization is basically how much is your stock worth. Let's say your stock you had 1 billion shares out and it's $10 a share. Okay, so the stock's capitalization is 10 billion. Billion times 10. Okay? And then the $10 share goes up to $12. Well, guess what? Now all that stock, $12 times a billion is 12 billion. So you just gone from 1 billion. I'm sorry, 1.2 billion. So you've just gone from 1 billion to 1.2 billion because the stock went from 10 to 12. Does that make sense? If not, and if you're driving, do not try to write this down. You can just call me. I'll walk you through it. I don't want you wrecking. Because I know myself. Actually, I try to do it in my head. but which is also very dangerous because you're driving and not such a good idea. Just give me a call. I'll walk through the math with you. So anyway, when you use capitalization or you use the value of the stock of the company as one of the criteria, what you can do is you can segment yourself into large, medium, small cap. You can, and they just rank them. They rank them by their sizes. If you add the speed to that, the capitalization actually overweights those that are worth more than the others. So if the share price has gone up, it's going to actually add to that holding. So it's got a momentum factor. I don't think they thought about it. I'm absolutely positive that they didn't think about that when they put these indexes together. They were just trying to get some idea of how to represent what was going on in the stock market, and this is what they came up with. So that's fine, and that's actually all the S&P 500 is. It's the top 500 by size, and that's it. They don't look at sales growth, profitability, none of that other stuff. My favorite funds look at the companies who are big for their category, the largest ones in their category by size, but also have profitability. And some of the really good performers have dividend requirements. So if you want to be in that exchange-traded fund, you have to be paying a dividend, and your sales have to be growing by a certain percent, and your profit margins have to be growing or at least maintaining themselves. That's I really like that combination, and it's had really good long-term performance. It's had a tendency not to be down for quite as long as some of the others that only use size and speed. And it's had a tendency to recover a little bit quicker. The last 10 years, they're hanging in there very close. They haven't been the best performers in 10 years, but they're right there. I mean, they're within 1%. And I'm just telling you, when the market goes down, those stocks typically are the first ones to come back. So I just got the heads up that I've only got about 50 seconds here before I have to go. So I'm just going to let you know this is Bill Bullington. Go to my website, bullingtoncapital.com, if you want to reach out to me. Other than that, have a good weekend, everybody. Good luck. Good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.